Hi, good day everyone. I am Okewo Abayomi, and in this video we'll be looking at the provision of IAS 28, which talks about investment in associate and joint venture. So let's go straight to the point. So the first thing is, what is an associate? So we will start this lecture by looking at what we mean by an associate, and in line with the provision of IAS 28, IAS 28 looks as an associate as a company that an investor has a significant influence. So an associate is a company that an investor has a significant influence on. So I'm an investor. If I have a significant influence on another company, that company will be seen as my associate. And the question is, how many percent of the shares of a company will I have if I'm looking at quantitative aspect before I can say that I have a significant influence? So the standard says that whenever you have 20% but less than 50% of the equity share of another company, it can be regarded as an associate. Though there is something I do say, the fact that 20 to less than 50% is the quantitative factor, but there are some times that having this may not really mean that you have a significant influence. And at the same time, if you check our earlier video on introduction to group account, where we establish control, I told you quantitatively that when a company owns more than 50% of the equity share of another company, we can say that that company have control. But it is possible in certain situations whereby a company will have less than 50% and the company will have control. But for the purpose of the standard, we are told that when we have 20 to less than 50%, in such case, we can say that we have a significant influence, though sometimes you may have to prove that. So the next thing we'll look at is, if I already know that an investor have a significant influence over another entity, the next question that will come into place is, what is the accounting treatment for such associates? IAS 28 told us that investment in associates should be accounted for using the equity method. But before we dwell into all this proper, the first thing anybody will ask is, what do we really mean by significant influence? In as much as we have talked about it quantitatively, that if you own 20% but less than 50% of the equity share capital of another entity, we can presume that you have a significant influence. But according to the standard, IAS 28 defines significant influence as the power to participate in the financial and operating policy decision of the investee, but is not control or joint control over those policy. So in this case, we are looking at a situation whereby having sold a particular percentage in the company give you the right to participate in some operating policy, e.g., you have a representative on the board of directors. Now you are not controlling the company, but you have a significant influence. You can influence the decision of the company, but you cannot control the company because you are not holding a controlling share in that company. And the standard also says, and it is not joint control. IFRS 11 talks about joint arrangement, where it says that joint arrangement is looking at a situation whereby two or more companies have a joint control. And what do we mean by joint control? Joint control is a situation whereby all the parties involved must have an unanimous decision for them to do something. So IFRS 11 talks about accounting treatment for joint operation and joint venture. But in line with the provision of IFRS 11 says that whenever we have a joint venture, it should be accounted for the same way an associate is being accounted for. Which means that if I want to account for joint venture, I am expected to also use the equity method of accounting. So, what is the next thing we talk about? We need to talk about how do we account. In as much as we know that IAS 28 says that we should use the equity method of accounting. Now, the next thing is, how does the equity method of accounting really works? So the first thing that comes when you are using the equity method is the cost of investment. Let me take you back to little double entry. If you invest, what would be the double entry? Money is going out, or any consideration you furnish is going out. So what do? I can credit my cash or my bank or anything I'm giving out, and I would debit the investment in associate, right? So after that, the next thing that can happen is, once I have investment in that associate, definitely whenever there is profit, I'm entitled to that profit, right? So in some material, what they do is they will tell you it is share of profit less dividend. Yes, which is very correct. It is either I less the dividend, I just put the net figure here, or I put them on a separate line. So in this case, whenever we have profit from associate, what do you think we are going to do? Profit is an income to us. Definitely, what will I do? I will credit my P&L and I will debit my investment in what? In associate, making my investment to grow. Next thing that will come into place is, what about if there is impairment? Impairment will reduce the value of my investment, definitely. So what do? I debit my profit or loss for my impairment, and I will definitely credit my investment in associate. Another thing that can come in here is an unrealized profit. When there is unrealized profit will reduce the value of our investment, because don't forget, the profit shared earlier year include unrealized profit, and since it included unrealized profits, we are expected to remove such unrealized profit. But one thing about this is that, unlike when I taught group account fully, when we were talking about a control whereby we are looking at a subsidiary, there is a different case here. The only portion of the unrealized profit that the investor will suffer here depend on the percentage holding by the investor. So which means that if I have 30% associates and there is unrealized profit, I am expected to suffer 30%, irrespective of who is the seller. Even if I'm the one selling to my associates, if there is any unrealized profit, I would take percentage that is owned in that company. Unlike when we were looking at a subsidiary, whereby if parent is the seller, any unrealized profit, everything will be suffered by the parent. For more information about this, you can check my earlier video which talks about unrealized profit. So in such case, we can have our total answer. So next thing we need to look at here is that, do we have any exemptions to the usage of equity method? Yes. In line with the provision of IAS 28, we are told that there are some investments that are held for sales. So the standard says that in that case, we cannot account for it using the equity method. Such will be accounted for using IFRS 5, which talks about investments held for sales. And another exemptions that we have is if the parent itself is exempted from preparing consolidated financial statement. So if you want to know about conditions or permission for exemption, you can check my first video, which is on introduction to group accounts. So another thing we need to discuss here is this. Now, it is possible that an investment in an associate can impair. and even the impairment, or maybe there is a loss which can make this figure, which we recognize in our statement of financial position here, to reduce. And it is possible that that amount can reduce to negative. But equity method of accounting does not permit us to recognize a negative figure. So we can reduce the value of our investment in associates up to 0, but it must never be negative. So next, we can then look at some work example to substantiate what we've learned so far. So, example 1. The financial statement of Romeo, Juliet, and Dance as at December 31, 2018 are as follows. So, we are given statement of financial position. We assume that all figures are correct. So, after that, we look at our additional information and we'll kick off from there. First thing says, Romeo PLC acquired 15 million ordinary shares in Juliet Limited in January 2013 for 25 million when the retained earnings of Juliet Limited were 5 million. Now, the first thing I told you from our previous video is that if I want to tackle a question like this, I need to determine my group structure first. Unlike other questions whereby we are given the percentage holding by the parent company directly, in this case we are told that they acquire 15 million ordinary shares. In which company? Juliet. Now, the question that will come into our head is that if I acquire 15 million shares of another company, the question is, what is the total shares available in such company? So let us check here. So I have 15 million. Let us come to Juliet. So this is Juliet Limited. Looking at the ordinary share capital of Juliet Limited, we are told that ordinary share capital of 1 naira each. So Juliet Limited we are working in thousands, so they have 25 million equity share. So out of 25 million equity share, you own 15 million out of that shares. So we can translate it to percentage. That is why I come here. 15 all over 25 times what? 100. That will give me 60%. So if I have 60%, this translates into having a control. So don't forget, if company A can control company B, in that case we refer to company A as the parent company, and as such company B will be regarded as the subsidiary. So in this case now, we have established the relationship that occur between Romeo and Juliet. So Romeo is the parent company while Juliet is the subsidiary company. No problem. So let us move on so that we take it one at a time. Let me quickly take you to additional information 3 so that we know that we finish group structure immediately. Additional information 3 says that Romeo PLC acquired 5.625 million ordinary shares in Dance Limited. So another company is coming into play now. Romeo acquired Juliet. Now Romeo is acquiring Dance. Now the total shares purchased, the same ideology applies here. If I purchase 5.625 million ordinary shares in another company, the next question that I ask myself is, what is the total shares available in that company? So I will come here to determine my group structure. I said I acquire 5.625. So coming to the financial statement under the equity now, what is the total ordinary shares available for Dance? We are told that Dance have 18,750. So we are working in thousands, so that is 18.75 million. So out of 18.75, we own 5.625. So let us translate such to percentage. So in that case, I have 5.625 divided by 18.75 times 100. In that case, we have 30%. From what we just discussed, from what is an associate, we said when we own within 20 but less than 50% of the equity share of another company, we refer to such company as our associate. So in this case now, I can refer to Dance as my associate. So in this case, I can say that the relationship between Romeo and Juliet is what? Parent and subsidiary. Why the relationship between Romeo and Dance? Dance is an associate of Romeo. There are things that you need to understand when we are preparing consolidated financial statements. An associate is not a member of the group. Yes, because the parent can only consolidate another company that it has control over. Dance in this case is not a subsidiary, it is an associate. So put it at the back of your mind. We don't consolidate an associate. Why? Because associate is not a member of the what? Of the group. That was why IAS 28 gave us the accounting treatment for associates, which we've discussed earlier, that we use the equity method of accounting for our associates. Now that I've answered my basic working one, I go to step 2, which I normally tell you. What is my step 2? I need to determine the net asset of subsidiary. Now, there's something I do here whenever I'm dealing with questions that have a subsidiary and an associate. I determine my net asset of my subsidiary, and I also determine the net asset of my associate. Yes, some materials, some videos will tell you it is not necessary to determine net asset of subsidiary, but the major reason there is for the purpose of proper understanding. So let us move to net asset of subsidiary. So I'm showing at the date of reporting. What is our reporting date? The reporting date is the date the financial statement is provided to us, and at the acquisition date we are looking at as at that date that we acquire this company. Why the difference between your date of reporting and your date of acquisition will give us our post acquisition. So let us move. So I go to my financial statement under equity. I'm dealing with subsidiary now. Who is my subsidiary? Juliet. So under Juliet, I have ordinary shares of Juliet to be 25,000. So I bring it in there at reporting. I have the retained earnings to be 22,125. I bring it in here. No problem. Don't forget, your share capital is the same thing at the date of acquisition and at the date of reporting. So I repeat it here. But let us go back to working note 1, additional information 1 rather. In additional information 1, we were told something. So let us go back to it together. We are told that Romeo PLC acquired 15 million ordinary shares in Juliet Limited in January 2013 for 25 million, when the retained earning of Juliet were 5 million. So which means that as at the date of acquisition, the retained earnings of this company stood at 5 million. So I will come here at the date of acquisition, my retained earnings are 5 million. So therefore the difference between at the date of reporting and at the date of acquisition will give me a post acquisition of 17,125. Very easy. Before I continue, let me replicate the same thing also for my associates before I talk about other things. So for my associate also, I come to my financial statement. My ordinary shares at the date of reporting is 18,750. You can see this is it here. My retained earnings at the date of reporting is this. Very easy and straight. I bring it in there. So I need to know what are these figures at the date of acquisition. To know this figure at the date of acquisition is simple. Don't forget, your share capital remain the same. My share capital is here is 18,750. At the date of acquisition, it is still 18,750. But the question you will ask me is, where is this retained earnings of 3,750 coming from? Let us go back to our additional information 3. Don't forget, additional information 3 provided us information about this associate. And what was that? We are told Romeo PLC acquired, this is it here, let me highlight it for you. Romeo PLC acquired 5.625 million ordinary share in Dance Limited on January 1, 2017 for 12.5 million, when the retained earnings of Dance were 3.75 million. You can see as at the date we acquired this associate, the retained earnings of this associate stood at 3.75 million. So in that case now, my retained earnings at the date of acquisition is 3,750 since I'm working in thousand. So difference between reporting date and acquisition date will give me my post acquisition date. You can see, very easy and straight. I've exhausted my additional information 1 and I've looked at my additional information 3. Now, since we've understood that, let us take a step forward. I come back to additional information 2. So additional information 2 says, at the date of acquisition of Juliet Limited, the fair value of its freehold property was considered to be 10 million greater than the value in Juliet Limited. Don't forget, whenever the book value of an asset or liability of your subsidiary is not equal to the fair value of that subsidiary, in line with the provision of IFRS 10, you are expected to make sure that you bring those things to their fair value. So in this case now, we are told that the fair value of that freehold was considered to be 10 million greater than the value in that book. So therefore, what do? There will be a need for us to do fair value adjustment. So where do I include my fair value adjustment? I include my fair value adjustment as part of my net asset of my subsidiary. So you can see we are not done yet. So my fair value adjustment is coming here, and let us see. So there is 10 million greater than the value in the book. So a typical example can be, maybe in the book the value is like 10 million, but the fair value of that asset is 20 million. In that case now, I will be doing adjustment of the balance of 10 million. So in this case, we are given the excess, which is 10 million. Whenever you are given a situation like this to do your fair value adjustment, that value will appear at the date of reporting and at the date of acquisition. So I will come here, the fair value adjustment, you can see at the date of reporting 10,000, at the date of acquisition is 10,000. But let us look at it in depth. If the value of my assets was understated last 2 years, for example, if I want to calculate depreciation last year, I will have used that understated value to calculate depreciation last year. This year too, I will have used that understated value to determine my depreciation this year. So because my asset was undervalued, it means that I will have been charging depreciation that is lower than what I will have charged normally. So whenever you have fair value adjustment, the next thing we discuss is additional depreciation, or sometimes excess depreciation. So let me say this at this point, in case there is anything we've discussed so far that I did not understand, check my previous video. We've looked at everything on their own. So fair value adjustment, there is a video on that. Anything you think you don't understand, you can check my YouTube video for other videos to address that. That is not an issue. So we look at additional depreciation. Let us continue here. So the question continues, said Juliet Limited had acquired the property in January 2013, and the building elements comprising of 50% of the total value is depreciated on cost over 40 years. Now, this is what they mean. In as much as our fair value adjustment is 10,000, 50% is land, 50% is attributed to building. Don't forget, land is a non-depreciable asset. So we cannot depreciate land. So we can only depreciate the building element. And what is the building element? 50%. So therefore, if you check here, you will notice that I only account for 5,000 here. What did they now say? We are told that we should depreciate this over 40 years. So 5,000 divided by 40 years will give me annual depreciation for 1 year. But don't forget, when did we acquire this company? We acquired this company 6 years ago. So which means that they've been understating depreciation since 6 years ago. So in that case, I will charge additional depreciation for 6 years. So 5,000 divided by 40 years times 6 years will definitely give me my depreciation. Don't forget, if you acquire company 6 years ago, as at the date you acquired them, will they have charged depreciation as at that day? No. So they will have charged depreciation over the time, but as at the date of acquisition, our depreciation will definitely be what? Dash. So therefore, this minus this will give me 750. So in that case, I'm done with additional information 1, additional information 2, and additional information 3. We are fine. So we then move to working note 4. What is our working note 4 in this case? Is how to determine our goodwill. And to determine our goodwill is simple. So the first thing we normally say is that we determine the fair value of consideration transferred by parents. That is, what are the different type of consideration that is furnished by the parent to the subsidiary. So let us go back to our additional information 1. We are told that the parent company paid 25 million in order to acquire this subsidiary, Juliet. So cash paid is 25 million. Very easy and straightforward. So if that is the only consideration transferred by parents, fine, we don't have problem. What do we add? We add the non-controlling interest, because don't forget, in this question we established that the parent company owns 60%. If the parent company owns 60%, definitely the remaining 40% is owned by other type of investor, which we refer to as non-controlling interest. So I will come here, non-controlling interest. How do we value non-controlling interest? We can actually value non-controlling interest using our proportionate method or using our full goodwill method. In case you are having issue with that, check my previous video on determination of non-controlling interest. Now let us check what this question wants us to use. Going through the additional information, let us go to the last additional information on our question. The question says non-controlling interest is valued at full fair value. So we use the full fair value method to value our non-controlling interest. Juliet Limited shares were trading at 1.6 just prior to the acquisition by Romeo PLC. It is very easy. Let me give you an hypothetical example. Let us assume that in a company you own 5,000 units of shares, and the current market price of the shares of that company is 2 naira, or let me say $2 per share. I can say that the value of your share is the 5,000 units of shares you own times $2 per share in the market. Very easy. Same thing too when I want to determine NCI. I need the total number of shares owned by NCI multiplied by market price of the shares of Juliet. So we are told that Juliet market price is 1.6, so we are fine. So the question is, what is the total number of shares owned by NCI? From the beginning of this question, don't forget, the total value of shares, let me show you here, the total value of shares in Juliet Limited is 25 million. Divided by 1 will give us 25 million ordinary shares. Out of it, parents own how many million? Out of that shares, we own 15 million. So therefore, NCI own the balance of 10 million. So if I want to determine the value of my NCI, I will come here, 10,000, you know we are working in thousand already, 10,000 multiplied by 1.6. So the value of my NCI is 16,000. Adding these two together give me 41,000. What do we do next? We less the net asset of subsidiary at the date of acquisition. Now you will ask, where am I going to get the net asset of subsidiary at the date of acquisition? Don't forget, additional working note 2. Under my working note 2 here, what did I determine? Net asset of subsidiary. You can see this is at the date of reporting, this is at the date of acquisition. So what will I do? I will pick the one at the date of acquisition. That is what I need. So I will come here, net asset at the date of acquisition is given to me as 40,000, which is very easy and straight. So addition of this give me 41,000. Let's say my 40,000 give me my goodwill at the date of acquisition to be 1,000. Now the next thing we normally ask whenever we determine our goodwill at acquisition is, do we have impairment? So let us check this question if there is any additional information that talks about impairment. So I think I've seen one. Let us look at additional information 5. What do we have here? The goodwill of Juliet Limited is impaired and should be fully written off. You can see that the goodwill we have here is 1,000, but examiner told us to fully write this off. If I want to fully write it off, it means that if I have goodwill of 1,000 and I'm writing it off, what will I do? I will write off all the old 1,000. Now, my goodwill at the date of reporting will definitely be what? 0. But we are not done. This impairment of 1,000, what will be the second leg? Who will suffer the impairment? Let me take you back a bit to our previous video. Impairment will be suffered by only the parent company if we use the proportionate method to value non-controlling interest, or what we call the partial goodwill method. But impairment will be suffered by both parents and NCI if we value our NCI using the full goodwill, or what we call the fair value method. Now, in this question, we are told that this NCI will use which method? The full goodwill method. So therefore, this impairment of 1,000 will be shared between NCI and parent company in proportion of their share holding. So when I get to when I need to share that, you already know what I'm doing. So I'm fine. I'm done with additional information. I'm done with working note 4. I can then move to the next one, which is working note 5. My working note 5 is to determine my non-controlling interest. To determine my non-controlling interest is very easy and straight. So I will come here as calculated. There are some times that they will give you the value of your non-controlling interest in the question directly. You pick the figure. But don't forget, in working note 4, we calculated our NCI to be 16,000. If I calculated it to be 16,000, it means that as calculated or as computed, it is 16,000. Now, NCI own 40% in Juliet Limited. If they own 40% in Juliet Limited, any profit generated from Juliet Limited, they are entitled to 40% of such profits. So my post-acquisition profit, 40% times 16,375. Now, someone will ask me, where is 16,375 coming from? From your workings note 2. Let me take you back to workings note 2. What is my post-acquisition profit? This is it here. My post-acquisition profit is given as 16,375. So they are entitled to how many percent of such? They are entitled to 40% of such. Very easy. Don't forget, impairments in this question, I've explained that they will suffer part of it. So the impairment of 1,000 naira, NCI will suffer 40% of such impairment. So therefore, we have 400. I've not spoken about unrealized profits, but I'll take you back. I'll bring you back later. So let us leave it for now. Let us go to additional information 6, which talks about retained earnings. And in case this is the first time you are watching my video, retained earnings in this case means the group retained earnings, or what some people call the parent retained earnings. So this is the portion that is representing the parent company. So anything that belongs to the parent company is expected to come here. So I will start with my balance brought forward. Now, where are you getting the balance brought forward from? Very easy. You are getting it from your statement of financial position. So I will come here under my parent company, which is Romeo. You can see that my retained earnings here is 36,500. So I brought it forward here, 36,500. So I'm fine. So in the subsidiary, parent company owns 60%. So if they own 60%, any post-acquisition profit, they are entitled to 60% of such. So I will come here, post-acquisition profit, 60% of 16,375. We get this. Also, the impairment of 1,000, since we use the full goodwill method, the parent company will suffer 60% of that impairment. So if I come here, impairment, 60% of 1,000 give me 600. So I don't have problem. So you understand up to that level. So since we are at par up to this point, there are other additional information that we've not talked about. So let us quickly look at it. We've looked at additional information 1, 2, 3, 5, and 6. But what of additional information 4? So let me quickly take you to additional information 4. What are we saying here? Additional information 4 says, Juliet Limited manufactures components used by both Romeo PLC and Dance Limited. Transfer were made by Juliet Limited at a cost plus 25%. Romeo PLC held 2.5 million inventory of this component as at December 31, 2018. So in a group, it is possible that the parent and subsidiary trade together, but we calculate unrealized profit if and only if the goods exchange within the group still remain unsold at the end of the year. So in that case now, look here, we are told that Juliet sold to who? Romeo. Who is Juliet? Our subsidiary is selling to the parent. So, and we are told that Romeo still have 2.5 million of that inventory in stock. If they have 2.5 million of that inventory in stock, let me take you back to IAS 2. IAS 2 says that inventory should be measured at the lower of cost and net realizable value. But don't forget, when Juliet was selling this to Romeo, they have marked it up at 25%. So, which means that there is a profit element in that 2.5 million. So if there is a profit element in that 2.5 million, what do? We eliminate that profit element. So let me come to additional information, working note 7, which will determine unrealized profits. So if I'm working in 1,000, the 2.5, that will be 2,500 plus a markup of 25%. That will be a markup. If it is margin, you just use your 25%, but the markup here, that will be 25 all over 125. So therefore we have 500. So my unrealized profit is 500. So let me do a quick revision of one of my previous video. In our previous video, we told ourselves that whenever there is unrealized profit, the first question you ask yourself is, who is the seller? If the parent company is the seller and there is unrealized profit, such unrealized profits should be taken to the retained earnings. So the parent alone will suffer that. But if subsidiary is the seller, don't forget, two people own the subsidiary company. Who own the subsidiary company? The parent owns 60% of the subsidiary company. NCI owns 40% of the subsidiary company. So if the subsidiary company is sold and there is unrealized profit, the owner of the subsidiary will be the one to suffer such unrealized profit. So this 500 will be shared between the parents and the NCI in proportion of their shareholding. That was why you can see here, so 40% of 500, NCI will take 200, while 60% of 500, the parent company will take 300. So if I come to determination of my NCI, that is where this unrealized profit is coming from, 200. And you can also see here unrealized profit here under the parent company, it is how much? 300. So but we are not done. That is one part of it. So still on the same additional information, see here now, in the same period, Romeo sold goods to Dance Limited. Romeo sold goods to Dance Limited. Romeo is the parent company, Dance is an associate. Don't forget, an associate is not a member of the group. And let me reiterate this. Unlike when we are looking at parent and subsidiary issue, whereby we ask ourselves who is the seller, when we are looking at associates, the question of who is the seller may not really be necessary, because no matter who is the seller, either the parent company is the seller or the associate is the seller, the parent company is going to suffer unrealized profit just to the tune of the percentage owned in that entity. So in this case, how many percent do we own in Dance Limited? We own just 30%. So any unrealized profit that occur in this question, the parent company will only suffer 30%. That is the only thing that differentiates how to determine unrealized profit under subsidiary and when we are dealing with associate. So let's move on. So I will come here, Romeo and Dance now, parent and associate. What's the unrealized profit? Goods that remain unsold is 2 million. I will come here 2,000. Same thing, markup of 25%. That is 25 over 125. We have 400. You can see, but this 400, we are told that whenever we have an associate and unrealized profit, the parent will only suffer the portion owned in that entity. So the parent company owns 30% of that entity. So which means this 400 now, the parent company is entitled to only 30%. So the unrealized profit here is 30% of 400. So the parent company will only suffer 120. So which means that I will debit my retained earnings with 120, and I will go and credit my investment in associates with how much? 120. So you can see, if you come here under unrealized profit, you can see dance 120. So I'm done with additional information 4. So basically I'm done with all my additional information, but there is something else we still need to do, which is our workings note 8. And what is my workings note 8? Determination of investment in associates. You can see from my previous explanation, equity method of accounting says that your investment in associates should be your cost of investment. Now, how much is the cost of investment? It is given in additional information 3. Come here. Romeo acquired 5.625 million ordinary shares in Dance Limited on January 1, 2017 for how much? 12.5 million. So my cost of investment is 12.5. Very easy. Add the post-acquisition profit. In the associate, I own 30% in the associate. So any post-acquisition profit in the associate, I'm expected to enjoy 30%. So 30% of 6,000. Where is this 6,000 coming from? Let me take you back to additional information 3, which is net asset of associate. What is my post-acquisition profit? My post-acquisition profit is 6,000. So in that case, I can see that my post-acquisition profit is 1.8. Double entry. I told you in my video, what is the double entry for profit? Double entry for my profit is to do what? Is to debit my investment in associates and to credit my retained earnings. You know, if I'm preparing profit or loss account, I will have credited my profit or loss. But since I'm preparing statement of financial position, which account is representing profit or loss? My retained earnings. So therefore, the double entry is I've debited this place with 1.8. I will come to my retained earnings, same amount, post-acquisition profit of dance. How much do we see? 1.8. So I move on. The next one is unrealized profit. The unrealized profit calculated here, you know, I told you, debit your retained earnings, credit your investment in associates. I debited my retained earnings by removing it here, 120. And what did I do here? I credited my investment in associates by removing it here, how much? 120. So we are not done. There is an impairment. Let us go back to additional information 5. This. The goodwill of Juliet Limited is impaired and should be fully written off. That is Juliet, which we've done. An impairment loss of 2.3 million is to be recognized on the investment in Dance Limited. So there is an impairment in Dance Limited. So we invested in a company and that our investment has impaired by 2.3. So what will happen? Double entry. I will credit my investment in associates and I will debit my retained earnings. So you can see my investments in associates are reduced by the value of that impairment, and what has happened here, my retained earnings has also reduced, and that is the end of all the additional notes. So totaling everything, I can get this, I can get my investments in associates, and everything is fine. Now that we are done with all the workings needed, the next thing is, let us now prepare the consolidated financial position. So we move. So Romeo PLC, as you can see, let us go back to our account. Before I start consolidating, let me remind you again, you don't consolidate associates. Put it at the back of your hand. You don't consolidate associates. You don't consolidate associates. Very important to know. So in this case, I'll start with my consolidation. So freehold property, this is it. Parent is 48,750. I bring it in there. Subsidiary Juliet 31,250. I bring it in. But can I consolidate Dance? No. Why? Because Dance is not a subsidiary, it is an associate. But don't forget, on our freehold properties, there was some adjustment that we did under our fair value adjustment. So let me take you back to additional information, working notes So let me take you back to working note 2. We go to our working note 2 to go and check. You can see under my working note 2 we have fair value adjustment for freehold, whereby there's a fair value adjustment of 10,000 and there's an additional depreciation of what, 750. So I will need to factor them in now. So determining my freehold, this is the parent freehold amount, subsidiary freehold amount, plus 10,000 fair value adjustments less the 750 additional depreciation, and that's all. I get my freehold property. Same thing applies to plant and equipment. No adjustment. I bring the one of the parent, which is 19,875. I bring it in, plus the one of Juliet, 9,375. I bring it in. No other adjustment. I put it here. Why am I not bringing dance? Because we don't consolidate associates. So the next thing here is investment. You can see we are just told investments. No, we are not told investment in subsidiary, investment in associates. So we need to be careful when you see something like this. We need to confirm that the total investment belongs to both subsidiary and associates in this case. And how do I know? If the total investment is 37.5, I will come here. How much was invested in subsidiary? If you go to your additional information 1, we are told that we bought our subsidiary for 25 million. And don't forget, we don't consolidate the investments in subsidiary. So in that case, I remove that 25. So there will be a balance. Abi, we are told that our associate also, we purchased our associate for 12.5. So if I remove that 12.5 too, you can see that my investment is actually 0. But the question you will now ask is, what about if I remove these two, there's still a figure? It means that that figure has to be consolidated. That balance will be here. Very easy and straight. So the next thing that normally come under assets is our goodwill, which is working note 4. Don't forget, our goodwill has been fully written off, so my goodwill here is 0. I will come here, investment in associates. In line with note 8, we have gotten our investment in associate under note 8 to be 18,880. So I will come here, investment in associates 18,880. So therefore my total non-current assets is given to me as 130,380. So I'm done with all this side. So I go to current asset. So under my current asset, what's the first thing I have? I have my inventory. So for parent, I have 14,375. I will bring it here. For Juliet, which is my subsidiary, I have 75. I will bring it here. But don't forget, we have an inventory in the group. The parent, Romeo, owed an inventory. But let me show you again so that we don't assume. This is it here. Romeo owed 2.5 million of inventory, which we calculate unrealized profit on. And the unrealized profit calculated was 500. You can see I wrote the double entry for you in this question. I said debit retained earnings, which we've done, debit NCI, and credit inventory with how much? 500. So therefore my unrealized profit will reduce my inventory by the tune of 500, giving my inventory to be 21,375. So I move on to the next one. After inventory, we have trade receivable. Parent is 8,250, subsidiary is 7,250. Adding both of them together give me 15,500. Same thing too with bank and cash. I will come here 1,250 and 3,000. Give me a total of 4,250. So therefore the total of my current asset, adding this together, give me 41,125. So my total non-current asset plus my current assets will give me my total assets to the tune of 171,505. So you can see that we are 90% done in this question. So I can then go to other side of business, which talks about equity and liability. Again, in case you've not been following my series on group account, you don't consolidate equity of the subsidiary. There is a fact that we don't consolidate associate at all. There is another one which says that you don't consolidate equity of the subsidiary. So which means that if I'm talking about equity here, I'm talking about the equity capital of the portion that belongs to only the parent company. So I start share capital, ordinary shares. In this case, my share capital for parent is 50,000, so I'll bring it here, 50,000. Add retained earnings. Don't do the mistake of putting 36.5. Don't forget, this retained earnings in line with note 6 in this question. Let us go back to our note 6. What is our retained earnings? You can see my retained earnings is 44,805. So I will come here, add retained earnings, 44,805, giving me 94,805. Add non-controlling interest. In line with note 5, let me take you back to note 5. My note 5, my NCI is given to me as 21,950. So if it is 21,950, I will come here, non-controlling interest 21,950, giving my total equity to be 116,755. So I'm done with equity portion. Again, you don't consolidate equity of subsidiary. So I can then move to non-current liability. So my non-current liability, the only one I have in this question is my 12% loan note. So you can see under parent company it is 12.5. I'll bring it in. Under subsidiary it is 2.5. Consolidating the two together give me 15,000. So I'm done with my non-current liability. The next thing I go to is my current liabilities. So for my current liabilities, the first thing I have is my trade payables. So for my trade payables, I have 17,000 and I have 8,750. So I'll come here, 17,000, 8,750, giving me a total trade payable of 25,750. So after trade payable, the next thing is bank overdraft. So the only thing we can see in this bank overdraft is the amount, which is 14,000. So, and this place it is 0. So I will come here, bank overdraft 14,000 plus 0, give me a total of 14,000, and boom, we are done. So addition of my trade payable and my bank overdraft will give me my total current liabilities. So my current liabilities plus my non-current liabilities will give me my total liability. Now I know my total equity. I already know my total liability. So equity plus liability will give me total equity and liability of 171,505. And if you come and check the asset side, so we have 171,505. And that is the end of the question. So for more amazing video like this, you can try to check up my YouTube channel. For anything you are not clear on, where I have a specific video which looks at everything individually, and by there you will be able to get in-depth knowledge of what we are doing in this case. And if this video is helpful, kindly share, subscribe, and turn on the notification button. Thank you.